Welcome back to another episode of What's on Your Mind. This time on the call, I've got two Goldman Sachs alumni and senior trading mentors at the Institute of Trading and Portfolio Management. It's David Perlin and Chris Cathey. Guys, welcome back to the show.
Great to be back.
Lovely to be back, guys.
We've got plenty to cover today. I'm keen to get your opinions on the macro environment and also some individual equity ideas as well as we go through the call. But let's start with the macro because it does seem like we're in a fairly uncertain environment at the moment, and there's a bit of a disparity between fundamentals and price action in the market. So David, why don't you kick it off with your views on the macro picture?
Yes, it is rather interesting. But before I get there, congratulations, England, on a very big weekend in sports. Cricket win, well done.
Fantastic.
It was nice to be the home team and win. And great fortnight in Wimbledon and Lewis Hamilton dominating F1 on home soil. All well done. Bravo. But moving on, the macro is still mixed, but the unloved equity rally continues. And Chris, Cathey, and I were talking before the call that, nobody seems to love this rally, but we are making record highs, nearly every day, at least in the U.S. And that, we've talked in the past about climbing a wall of worry where you put these obstacles that the market has to overcome. And that certainly continues. But let's face it, this is really all about the yield environment, the fact that central banks continue to be supportive, that the Fed, which made this pivot in December to be accommodative again, is all but expected to cut rates in a few weeks and continue to do so. So that is the backdrop. That's what's driving the belief that this expansion can continue and that we have to respect price action. So that's really the macro from where I sit. In a world of negative yields, equities are interesting and attractive, especially in the U.S. where this expansion has been able to continue.
Sure. Does it make it quite different then from the last sort of 2 or 3 cycles because we are at such low interest rates? Is it what makes it different in terms of analysis?
Well, I think it's a very interesting point that Dave mentioned, that sort of climbing the wall of worry. Yeah, it's an old adage, and it makes sense because there's always reasons why and goes long, we're going to take profits, etc., and why the market is peaked. But to totally reiterate what Dave said is that it doesn't matter what your view is, you have to respect the price action. As traders, we have to always respect the price action. S&P's making an all-time high. We have to respect that. Now, does it make sense? Well, it doesn't matter because it is what it is. The price action is telling you that the S&P is higher, and the fact that it's not loved means it's probably going to keep on going, at least for the foreseeable future. They know when everybody gets bullish, then we're getting close to a top. And there's nowhere anywhere near that yet. Now, negative interest rates, the Fed, pretty much the only place in the world that actually can cut rates, because in Europe, German bond yield, 10-year bond is already negative 0.25%, 0.25%. France is on zero. The only one slightly positive is the UK. And when you said compared to previous cycles, you've got to bear in mind that we've never really been this low interest rate environment ever. The only comparable really is Japan from the 90s onwards, and that's not a very worrying. That's a rather worrying situation especially for Europe and potentially for the US, because if you get used to low interest rates, we don't know how this is going to play out. The Japanese example would suggest that it's not particularly good, but this could last for a very long time. So the VIX is at 12.5, should be risk on, but something doesn't quite make sense to me, I must admit. But it is what it is.
It does seem strange that you kind of you sort of look at interest rates as a floor if it's at 0, but then even beyond that, you've got QE and negative real rates or whatever. So it makes it hard, I think, to understand what can happen, and equally central banks seem to be reacting quite quickly to the market and not just the economy.
Yeah, well, absolutely. I think what you think about what does negative interest rates actually mean is that you're paying money to lend money to a government, to a company. It's like that kind of flies in the face of all economic fundamentals, that you have to pay to lend your money. How does this play out? Well, who knows? But I think at some stage we're going to have a shock. But it's a very, very unusual environment that we are in, and it's kind of funny that, we're talking about the Fed cutting rates. Yeah, like Dave said, pretty much priced in that we're going to cut within 2 weeks. The next meeting, the end of July. But bear in mind that US inflation is still just below 2%. So 1.6%, I think the most recent number is. Unemployment is pretty much close to record lows. So you kind of have to wonder why the Fed cutting rates when unemployment's so low. Inflation's sort of, it's low compared to historical averages, but it's not we're nowhere near deflation. And the leading indicators are still holding above 50. Yeah, the PMI is just above 50, but doesn't indicate we're in a recession yet. So I think there may be an element of the rhetoric Donald Trump's been using to put the Fed under pressure to cut rates seems to be paying off. Does it make sense? Well, it doesn't matter. You have to respect what the action is and what the price action of the market is.
Yeah, so does that sort of add up with your view as well, David?
Yes, I think totally agreeing with Chris, we would typically not expect a central bank to be cutting rates during an ongoing economic expansion with unemployment as low as it is and with corporate profits as high as they are, and quite frankly, where risk assets are priced. But they're phrasing this as kind of an insurance cut. Inflation isn't that high, so they know that they can move. We are, by definition, still at positive rates and real rates versus the rest of the world. So that's why the market's discounting this 25 basis point cut. And obviously, we have a leader who tweets about rates being lower and markets being higher. So we're in this weird time, but we have to respect price action, as I said earlier, and that's what's likely to occur. And that can prolong this kind of money flow into stocks. Again, climbing the wall of worry. The tariff situation, although not settled, has been kind of kicked down the road a bit.
Yeah,
certainly not an escalation, and that let this market kind of make the new high. I think that was the room the market needed, in addition to Powell being fairly obvious that he's going to do an insurance cut in 2 weeks' time.
Sure. Where does that kind of lead in then, if we're dealing with that uncertain macro view, where does that kind of lead to in terms of sectors and other things you're looking at?
Well, personally, I'm looking for things that are even more unloved than this entire rally. And I'll talk about a couple of things today. I'd love to start with the energy space, just for historical perspective. Once upon a time, the energy sector was about 20% of the S&P. It is now about 5% of the S&P. So this long rally has occurred without energy, oil in particular, rallying. And you can, sort of understand that philosophically, because crude was once upon a time $100 and now it's 60. And over that time, the U.S. has become a net exporter, which is a really wonderful trick. To be energy self-sufficient in the new decade. So what we have is a sector that's unloved even more than the overall market, and some value. The other thing that I want to get to my thesis today is that in a world of negative yields, let's find some dividends. And Chris and I have been talking about that in previous iterations of this, but one sector that people, especially kind of high net worth investors, which is kind of the space I'm in anyway, are it's called MLPs, Master Limited Partnerships. And essentially, the U.S. tax code allows pipeline companies in America to organize in a different and more preferable tax treatment, which is helpful to rich people because they can get a better, higher capital gains exclusion from this particular class of stocks. And essentially, these stocks are all high yielding. So if you look at the MLP world, starting from an ETF level, You've got three in particular that have fairly large allocations: MLPX, AMLP, and TPYP. And if you drill down and look at the technicals, they're all having a decent year, but certainly lagging kind of the robustness of the overall market. And if you drill down to the holdings and start looking at specific stocks, which we'd rather do, the two I come up with are Energy Transfer, ET, and Kinder Morgan, KMI. Both have substantial dividend yields, attractive charts, significant components of these ETFs. So as the ETFs get allocations, these stocks will benefit. So I'm looking at something that is a little bit off the path, but fits the backdrop in the macro, in a sector that's unloved, and with dynamics that make sense to me. So that's kind of my beginning salvo in a world that's a little confusing. Furthermore, the energy backdrop is fairly favorable. We've got domestic economic activity that seems to be sustainable, especially with the Fed's help. So these are very domestic-focused companies, and they are slightly sensitive to the overall price of crude, but not directly. But I would foresee, given the Middle East turmoil and the ongoing Iranian situation, that crude oil is probably not going to go down a lot in the next 6 months, and that's really the play. 6 months, 12 months, high dividend, energy as a sector, unloved and underallocated, and a oil price that's probably sustainable.
Sure.
I totally agree with you on the oil price, Dave. I think given the sort of the geopolitical risks, clearly, which are potentially escalating in the Middle East, then it seems that the downside in oil is rather limited right here, right now. But it's funny, sort of, when you talk about dividend yields, that just to sort of put it in numbers, I mean, the yield on the S&P is just less than 2%. The yield on the government US 10-year is just over 2%. So there is no equity risk premium. And I love the fact that you're sort of talking about sort of unloved sectors and an unloved rally. I mean, this also seems to me, I think we're on the same page, that when you're looking for things that haven't moved in the market, which is an all-time high, that makes me think that we're probably getting close to some kind of, I don't know, some dislocation, personally.
Yeah. But
it's not going to happen yet.
Yeah.
And I think chasing yield is a great idea, but it's kind of, it almost feels like the final throw. But like I say, the Fed are spiking the punch bowl. They're not taking it away.
So what
the party continues. Yeah.
Exactly.
What does that mean? So on your side, Chris, what have you been looking at, bearing in mind the kind of thesis? Are there any sectors in particular, or is it growth, value, something like that?
I'm still in the just sort of a few of the positions that I've been talking about over the last couple of calls with some of my old favourites: Procter & Gamble, Waste Management, and a year player REIT Store. I mean, they've all outperformed the market, and marginally, not really particularly in the last I'd say the last month or so, but they're all yielding. Waste Management yielding 2%, so bang in line with the 10-year. Procter & Gamble's yielding 3%, Stores yielding 4%, but I think they're all. Personally, I'm looking to reduce risk, which kind of sounds crazy given the fact that the VIX is at 12.5. This should be the time when you're putting on full long short portfolio. This is when it's risk on, but the dislocation between what I see as the price action of the equity market and the economic fundamentals makes me think that we've got some kind of issues coming down later down the line. And again, reducing some of the shorts, which have done nothing. You look at the performance of US Steel, Alcoa, it's sort of another one, the tech name we've been talking about. They've done nothing in the rally, which when the market's at an all-time high, if you've got shorts which are not going up, they are fantastic shorts. But I've seen these kind of dislocations between price action and fundamentals, and it makes me more inclined to take risk off than put risk on, which is probably not what you want to hear, but I'm just telling you my view. That's what's on my mind.
Well, one thing that springs to mind in that situation is that perhaps options are a good way to express some views if volatility is relatively low.
I think with a VIX at 12.5, you should be looking to really be putting your positions on via calls and puts, especially on the put side, because obviously if we do get some kind of correction, get a spike in volatility. But I think the risk reward of being long calls and puts versus CFDs from a European perspective is definitely in your favor.
Absolutely. Totally concur.
Yeah, because I personally, I don't think volatility is going to stay this low for between now and the end of the year. So if we're looking at sort of a 3 to 6 month view, I would expect some spikes in volatility between now and the year end.
We actually have a couple of things to watch for in the next few weeks. There's some budgetary, geopolitical U.S. stuff to get through. We have a debt ceiling to raise, which gets to the soundness and guarantee of U.S. Treasuries. And we've got a budget process soon thereafter. And given the politics in America, this is not a slam dunk, easy. So that's just something to be mindful of. They'll play some brinksmanship, but they're trying to get at least some extensions to make it smoother. So we'll see how that plays out. I'm personally in the camp that, we have to respect how well the market's behaving, but that at some point it gets rockier, like December last year. And my humble opinion is, as we get closer to an election, there'll be a determination that we're too high and there's too much risk. And I think no matter what the outcome, most people will take some risk assets off going into that event. But that's far in advance from where we are right now.
That's the whole world could change between now and the next election. What's that, November? So it's over 12, 13, 14 months away.
Yeah. But I mean, looking more closely ahead, we're obviously coming into earnings season as well now. So is that another good time to think about options, especially if we are of the perspective that some of the macro data might be mixed, so could end up in being some volatility?
Very much so. Exactly. Running into the sort of second quarter earnings is express your views via options rather than CFDs, because obviously the huge positive options is what your downside is with your long volatility. But it's funny you mentioned the second quarter earnings season. Expectations are actually for a 3% year-on-year EPS cut across the S&P 500, which again doesn't quite fit the fact that the S&P is at an all-time high. So again, this is where I'm concerned about there's a disconnect between equity prices and the economic fundamentals. If we're looking for a 3% year-on-year EPS cut, that doesn't quite fit with the fact that the S&P is at an all-time high. But like Dave said, we've got to respect the price action.
Yeah, I would say that earnings are setting up to be of some concern, but seemingly the market's discounted the fact that there should be some cautious guidance given the fact that this tariff situation is not resolved, and that everybody's in on the joke. So they're discounting the fact that maybe if I'm a CEO, I should be a little bit more muted for my second half outlook.
Yeah.
But of course I'm going to be muted because I want to beat and get paid more in my bonus at the end of the year.
Exactly.
And let's all be aware, CEOs get paid stock and options. Yeah. So it's in everybody's interest to maybe constrain expectations and then beat them as this gets resolved. And I think everybody's in on the joke that both the U.S. and China want a resolution at some point in this issue.
Yeah.
But that's the game at hand in the earnings season. It's less about what the current quarter is, which I think is okay, but more about the outlooks.
Absolutely.
Is there anything interesting going on kind of outside of the US and obviously the trade war story? Is there anything that you're looking at, whether it's macro sectors or specific equities, that are a little bit out the box? Chris?
Cheers. I would say, here in the UK, obviously the focus is on running up to Brexit and Halloween and new Prime Minister next week. I mean, right here right now looks like it's going to be Boris Johnson. But we briefly talked about the US election next November, a year on November. It seems to me whoever takes over the PM in the UK is just inheriting a problem, which is going to be a disaster within 6 months. So I would stay well clear of the UK. In terms of Europe, I think now again mentioned the world of negative interest rates in the eurozone, with the potential sort of Japanese play out. But also you did mention about the demographics of Japan being slightly different to Europe, but not dramatically so, given how Europe's sort of playing out. I would start to see some value in Europe relative to the US personally. I mentioned this in the super conference about sort of the Euro stocks against the S&P 500, pretty much at all-time wides. I would suspect that this is a trade that I'm going to be looking to start to put on over the next few months, starting to get long Europe and short the US, which I think why on earth on the economic fundamentals. But I think that if we do get some kind of general risk off in equity prices, sort of risk off in risky assets, equities, then I think that Europe's going to start to outperform the US, maybe on a sort of 6 to 12 month horizon. So it's not a trade that I'm going to be fully invested in right here, right now, but it's definitely something I'm looking to put on over the next few months.
Is that something that tends to happen a little bit towards the end of a cycle? I suppose it's different from a macro perspective, but both of you have mentioned about looking on a sort of value basis. David, you were talking about looking at equities on a value basis, I guess, as opposed to growth, right? And the same, yes. Chris, with you on the macro side, there's now a disparity. Maybe there's potential for a convergence of the difference in performance of Europe and the US.
Yeah, I think you read between the lines of what Dave and I are saying, that we're all on the view of that this is probably coming close to the end of the cycle. Yes, if we're looking to put dividend trades on or value trades on, which have hugely underperformed over the last 10 years, then yeah, it all smacks of sort of a little bit of towards the end of the cycle. What do you think, Dave?
Totally. I think, the growth over performance versus value has never been more dramatic than it's been over the last, 10 years of investing. Calling an end to that is kind of a fool's game.
Oh, completely.
It's been 10 years, but if we can find things that make sense given the other backdrop, not just value for the sake of value, but reasons to be in a value-oriented story, is certainly valid, and I think that's what we're both trying to achieve here.
Yeah.
Sure.
But I don't think these are trades that you need to be right here, right now, fully invested 100%.
Yeah, like you said, it's waiting for price action, right?
Yeah,
absolutely. And I think the other interesting tension in the world is some apparent currency stress where Trump wants a lower dollar, and that has not been the philosophy of the U.S. for some time. It's been a strong dollar policy. So I think that's something for all of us to keep mindful of, because it will have an effect on relative performance in equities on a global basis. Again, more of a watch and see if it's truly going to happen. But he wants the dollar to be lower. He wants to be more competitive in trade, and that's all tied together.
Mm-hmm. And that could be sort of a second or third leg of currency wars around the globe, I guess.
Precisely. It doesn't sound like everybody's lining up to do that, but it's just a space to watch, and he's obviously been vocal about that. So we'll be talking about that in future episodes, I'm sure.
I agree with Dave. I think we could skip forward 3 months, and then we could be talking about a potentially very different macro environment.
Just looking at my notes here as well, David. So there was, I think you had another idea that you were going to talk about, which was a pain trade potentially.
Yeah. I love pain trades. let me define that for you. When something continually works and everybody's in it the way it's been working, the reversal of that trade is the pain trade. And what I mean about is essentially crowded trades where hedge funds and institutional investors are lined up kind of unequally in a pair sense. So I think the pain trade resides in industrials, which have been largely lagging owing to bearing the brunt of the tariff war thus far. So within the industrial space, the sector that's supposed to be rallying to support a higher record Dow and S&P are the transports. So I look at the transports. I look at the IYT ETF, which is a broad transportation index, and there's an internal struggle within that ETF between U.S. domestic trucker delivery, if you look at FedEx, UPS, JB Hunt, et cetera, and railroads, so KSU, Norfolk and Southern, et cetera. And if anybody has watched this, the railroads have had a stellar year, and the truckers have had a horrible year. And I think there are a couple of factors involved, mostly who's most susceptible to tariff, but also in America, the fear that Amazon is just going to decimate home delivery service, so the UPS FedEx threat, if you will. And I think that's probably starting to be overplayed or overdone. So I'm looking for a reversal within this ETF in specific pair. I want to be long UPS, and I want to be short Norfolk and Southern. And on a technical basis, Norfolk and Southern has a perfect double top formation. And I just like this relationship. I think it's two offsides, if you will, where people are way too long the railroads, and the unloved kind of delivery stocks. And I think these two pair up perfectly. So long UPS, short KSU.
Sounds good.
Yeah, so the themes basically we've talked about today are essentially risk off in the portfolio or reducing exposure, looking at value, and also perhaps taking advantage of volatility, low volatility, by using options to express some ideas. So fairly defensive themes. But yeah, that's great, gents. I think we've run out of time for this episode. It's been great as always to hear your opinions, especially when we are in this uncertain environment and we're heading into an earnings season as well. Always great to hear your comments, so thanks for those. For those of you watching, there's a couple of things that I want to point out just before I close the episode. The first one is that we've just released our London presentation videos that we did for our super conference last month. They're up on the website now, so you can go and have a look at those and stream them yourselves from home. And secondly, I just wanted to point out that we've only actually got one more live seminar in our calendar at the moment before we take a break, and that's due to mentoring commitments. And that seminar is actually on the 27th of July in Hong Kong, hosted by Ross Williams. So if you guys are keen to come along to a live seminar, then make sure you try and get to that one. So that's all I really wanted to say. I hope you guys enjoyed the episode, and make sure you join us next time for another episode of What's on Your Mind.